Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always is Vini Motiwala. And one of the major rules for investing is have goal-based investments. And we spoke about some goals that we can achieve via mutual fund investments. Last week it was education, travel as well. And today we are going to pick up one more, Vini.
Absolutely. Today let's pick up on how we should build a dream of owning a home, and will mutual funds actually help us with that is something that we'll be watching out for. Now that's what we'll be talking about. Given that property prices are rising, there is increase in costs, savings for a down payment can be a hassle. But what if you can actually leverage mutual funds to make your dream and make that into a reality? That is important, right? Today's focus is going to be on how mutual funds can be a game changer to build your portfolio in a way that you could be buying a home, paying the down payment as well. To help us understand the right investment strategy that we should be following, what are the tax implications that come in as well, we have our experts joining with us today. We have Kshitij Mahajan, co-founder of Complete Circle Consultants, as well as Tarun Birani, founder and CEO at TBNG Capital Advisors, to talk to us
Tarun,
about this.
let me come to you. First up, your thoughts on what's the time horizon and type of mutual funds for building a home, the purchase corpus, it should be short-term, medium-term or long-term, and also how can we split those investments, say between equity, hybrid and debt mutual funds?
So good afternoon, and it's a brilliant topic and a topic I enjoy talking on, goal-based investing. I strongly believe that the purpose of an investment is not to achieve risk-adjusted return, which I think I can see a lot of noise around generating high returns, put money here, make more money. I think the objective of investment is to help us achieve our financial goals. I think that is how we should look at investing. And that is where the topic which we have selected today, I think it resonate with that how can this investment can help you achieve that goal. I feel for home buying, especially under the today's uncertain environment and condition we are in right now, the calendar and not the market should determine your portfolio structure. Mind you, the word is calendar. So money behaves differently over time, and the shorter your time frame, the less room for error. That is something we need to be cognizant of. So that is where I feel we need to divide our buckets for 3-4 time frames. So let's say between 1 to 3 year horizon, the focus should be more on preservation of capital. So for preservation of capital, right from liquid funds to arbitrage funds to your short-term funds or money market funds, all these things can be used for that. Anything which is 3 to 5 year horizon are so again it depends when are you planning to buy that property. If you have 3 to 5 year horizon, you can look at asset allocation categories. There are a lot of new structures in fund of fund structures which are available in the market, which I feel are brilliant to achieve these kind of goals, because they give you access to a lot of asset classes which can be built if you have a 3 to 5 year horizon. Some mix of hybrid kind of structures also can be looked at, and if you have a 5 year plus horizon, definitely you can look at some 60 to 70% equity allocation in your portfolio, again heavily tilted towards blue chip category, because I feel for a goal like home, I think we should not look at dabbling into high risk category like small and mid caps.
Okay, and Tarun, Sonal was also asking in terms of a breakup. What should we do in terms of the breakup between equity, hybrid and debt mutual fund? How should we be dividing that?
So again, it depends purely on the risk profile and the time horizon, right? So as I mentioned that if you have a 5 year plus horizon, it is good to have a 70% plus equity structure. If you have a 5 year plus horizon, if your horizon is say between 3 to 5 years, then maybe anywhere between 30 to 50% equity structure could be looked at. And if your horizon is less than 3 year, I feel you should be largely into debt oriented assets.
Okay, all right. Kshitij, your take on this? How should one split investments between equity, hybrid and debt mutual funds? Of course, you said not 100% should be in equity. Is there a specific split that you would like to talk about?
So again, it depends on what's the time horizon when you are buying you're planning to buy your home, and what type of amount you're looking at as a down payment. let's say, because you're not only planning for your home buying only, you have other plans also. I think if it's specific to home buying, I think it should be 5 to 10% in arbitrage. If it's more than 5 years, I'm saying, you have time frame. And broadly should be flexi cap and multi cap equity that one should look at. Small or mid cap can be little risky because for that home loan goal, because they can be much more volatile than flexi cap and other categories. And then you should keep 20%, so 10% arbitrage, 25% your hybrid category. That includes multi-asset, hybrid, BAF, and remaining 60-70% pure flexi cap, multi cap category funds. That's one should look at while aligning their goals or aligning their SIPs for home buying.
Okay. Tarun, what's your view just coming in, given that real estate, the inflation also is something that we're seeing. But how should one be managing this with mutual fund? Is it possible to beat that inflation and manage that risk?
Yes, I think real estate, if I look at, and I'm dividing real estate in 3 different sub-markets. So talking about urban areas or the metros, talking about tier 2 cities, and maybe third could be more, let's say, towns we are talking about. So I have seen the growth rate of real estate in all these 3 sub-markets are very different. Markets like metro markets have not seen the growth, the real estate growth had been lesser compared to tier 2 cities. So I think depending on the location where you are planning to pick up real estate, you need to align your investment accordingly. Yeah. So when you are looking at, let's say, beating the inflation, and I have seen largely the rate of inflation is the rate of growth of real estate in these metro markets at least. So maybe if you want to beat the inflation, you need to definitely look at a higher equity tilt in your portfolio, because as we have seen in last 10, 15 years, the equity returns have been say around 12% and above, right, on a long-term basis. So that could be one asset one can look at. But the real growth can outpace the property price appreciation, provided you have a long runway enough. I think it all depends on the runway, the time horizon you have. Based on that, you can select the asset allocation in the portfolio.
Got it. Tarun and Shritish, this is very helpful, but we have to get into a quick commercial break. When we come back, we'll discuss more on how to use mutual fund investments to fund your residential house.
Welcome back to MF Corner on CNBC-TV18. We still have Atasha Mahajan as well as Tarun Birani, and today we're discussing how mutual funds can actually help fund your dream to build your home, buy a home as well. Shritish, while we've spoken about, the time period, the approach that comes in, given the time period as well, what is better? Would one go for SIPs? Should one go for lump sum approach? Or is there a mix that one should be following to achieve this goal?
Well, Vini, it depends on what type of cash flows one is having while approaching his goal of buying a home. But yes, SIP always benefits you because there's a discipline through which you keep on putting money on a monthly basis. There is a process through which you keep on accumulating units. And then you certainly see after some time, if you go a little long, let's say 7, 8, 9, 10 years, that the multiplication and compounding effects coming very rightly in your investments. At the same time, if you ask me, if somebody is having a lump sum money and they want to keep this money aside to buy a property, then I think rather than just putting that money in one go, they should look at doing a STP in the same fund in which you're doing a SIP. So let's not get into a lot of funds. Let's say if you decided to 2 funds to allocate towards your home loan goal, let's divide that money in 2 different corpus and half of corpus, and then deploy over a period of time. So equity actually gives you to combat with as you rightly said in the last question, with your real estate inflation also, because over a period of time it has delivered better return vis-a-vis real estate. So I think the right approach is doing a STP in a lump sum, but at the same time complementing it with a SIP strategy, which always helps to build a long-term corpus.
Got that. Tarun, then in case when we are approaching the purchase date, how and when should investors shift from, say, equity funds to, say, for debt funds and vice versa?
Correct. So I think this is one of the very critical things, and based on my experience, I have seen a lot of accidents which can happen if this is not planned in a proper way. So let's take. So what I'm talking about is rebalancing. The rebalancing of the portfolio need to be done correctly if you want to make sure that when you have to actually pay the money, you have the money available, right? So just to give you some context here, that equity allocation should reduce as the goal date approaches. So let's say if you are more than 7 years away for your goal, a higher equity allocation, say 60 to 80%, based on the risk tolerance, can be maintained. If you are 3 to 5 years away, start gradually shifting a portion from equity to short-term debt or hybrid funds. If you are 2 years away, entire goal corpus should ideally be into low risk debt funds or a liquid fund, money market fund, or ultra short term duration. Again, why gradual rebalancing works, I think it avoids trying to time the market with one big shift. It gives you smooth out exit load and as well as taxation impacts also. Again, it helps you lock in gains progressively, protecting the purchasing power of your corpus. So my suggestion would be we should plan it in a very, very strategic way and not to let it come for the last day when you have to actually pay for your property.
Absolutely, gradual shifting will also be key and not a last-minute strategy that should be followed. Kshitij, are there any specific categories of funds or any specific fund right now that is looking attractive if someone is doing this or, moving or rebalancing their portfolio right now, whether it's a short-term or a long-term fund? Anything that you could give us on that front?
Yes. The reason when you are shifting, when you are approaching your goal towards a safer asset, I think one should look at the fund with the lowest volatility. Right now, the main purpose is preserving our wealth rather than just getting that extra buck or extra kicker. The most important point is, let's say if your date is coming on 1st of January 2026 and you have, let's say, 5 more months or 4 months to 4.5 months to go, then you should look at how you can save that asset. So I think one should park funds in overnight funds. They can look at parking in liquid funds. If you have 1 year plus time on your side, then I think arbitrage works really beautifully. But again, I will not ask everyone to look at just parking everything in arbitrage fund, because arbitrage has a tax advantage because 1 year plus it's 12.5% only. Other asset classes are been taxed as per your tax slab. So I think a mix of overnight fund, liquid fund, or let's say short-term fund and arbitrage fund if you have funds over more than 1 year to buy your home. So that's how one can look at.
Got it. Let's talk about the tax implications, Tarun, because that's ultimately very important when you consider investments as well. So what are the tax implications someone should consider when redeeming mutual fund investments for buying a house?
The mutual funds are divided into, again, equity funds, fund of funds, debt mutual fund. What kind of funds you are picking up, based on that, taxation will be applicable. So for typically for equity funds, arbitrage funds, less than 1 year horizon, you have a 12.5% taxation. More than 1 year, less than 1 year, it is 20% taxation, and more than 1 year, it is 12.5%. Debt funds, again, after, if you have bought the debt funds after April 1st, 2023, all gains are taxed at your slab rate with no indexation. So they are at par with most of the fixed deposit taxation rates. So again, if you are holding any old debt investment, review their purchase date before redeeming. They could significantly affect your tax liability. Spreading redemption across financial years can further help you minimize your tax burden. Again, one very important part is some part of your capital gains you can adjust with buying a property also. So that tax advantage also you need to be aware of, because these tax capital gains can be adjusted against the property purchase also.
Okay. Okay, Kshitij, a very quick one because we are almost out of time. But what is the SIP amount one should be looking at currently if they want a corpus of around 30-40 lakhs in the next couple of years?
So let's take, for example, a reasonable rate of return, 12% on the investment side. And at the same time, let's look at that, that you have inflation, which is real estate inflation at 5%, which is going. So what we are looking at is right now, if you have to do that, and let's say if you're looking at 30 lakh of investment right now, which will cost you around 40.2 lakh over a period of time. Once you look at a corpus of around 38,550 rupees, if it's 20 lakh, you need to have, because with inflation, after 5 years, 26 lakh is something which is required with 5% of real estate inflation. Then you need to have close to about 25,700 rupees as a monthly SIP, which one has to do. We are assuming that your money will grow at 12%. So that's an assumption to take into account.
Got it. Of course, that is the assumption that we are going with. Thank you so much, Ritesh and Tarun, for joining us today and taking us through the points that we need to keep in mind, the viewers need to keep in mind when they have to use their mutual fund investments for buying a house. It was a pleasure speaking with the two of you. But with that, we have completely run out of time on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.